Taxes. Not a favorite topic. However, taxes have a significant impact on real estate investments. In CCIM analysis, we'll focus on federal income tax. It pays to get up to speed on tax codes that impact cash flows from acquisition, ownership, and operation to disposition to fully understand the benefits of real property ownership after tax. The focus of the tax world can be summed up in 3 questions. How many of the dollars going in and out of an investment will be subject to tax? How much tax will be owed? And when will that tax be paid? The answers to these questions are not always what you would expect. Tax laws are subject to legislative discretion and may not seem aligned with real-world economics. 2 important characteristics to consider for tax purposes are the transfer of money and the timing of cash flows. First, money does not need to transfer between 2 people to have a tax impact. This is the case for cost recovery, commonly known as depreciation, or wasting and wearing of an asset. So when an asset, such as carpet, wears out, the investor doesn't actually receive money back for the wear and tear on the carpet. However, the investor can write off the wear and tear through a cost recovery deduction, thereby reducing the actual amount of income on which the investor is taxed. Second, the timing in which money is received or paid may have a tax consequence that occurs long after the transaction is reported. For example, for commercial and investment properties, loan fees or costs are not deducted in full in the year they are paid. Instead, these loan fees or costs are prorated and deducted for tax purposes over the term of the loan, and any unamortized loan fees or costs are expensed in the tax year in which the loan is paid off. Let's move on to tax classifications. In the tax world, real estate ownership is based on who pays the taxes. Taxable entities are individuals, sole proprietorships, and C corporations. Pass-through entities are general partnerships, limited partnerships, S corporations, which are corporations taxed as partnerships, limited liability companies, or LLCs, and limited liability partnerships, or LLPs. Institutions, both profit or nonprofit, include real estate investment trusts, or REITs, as well as religious, environmental, and cultural organizations. A taxable entity must pay income taxes on the income their real estate investments generate. The amount of tax each entity must pay is computed using different rate schedules. The taxable income and tax obligation for pass-through entities flow or pass through to the investor. For example, the tax liability from a property a general partnership owns passes through the business entity to each partner. Therefore, each partner is responsible for paying a share of the tax liability. A member of a pass-through entity is not necessarily a single individual. Multiple corporations may combine to form a partnership or LLC. Also, one investor may be involved in more than one pass-through entity. Those investors are responsible for their portions of the tax liability for each entity. The second classification is of the property itself. Under the tax code, assets are tangible or intangible, or real or personal property. Real estate is a tangible asset. It has several further distinctions. A personal use asset. This asset is held for an owner's private, non-business use, such as a house. Inventory property. This asset is a property held primarily for resale to customers, such as a house that a contractor has built for sale to the public. Investor property, or Internal Revenue Code, or IRC, Section 1221. This asset is a property held primarily for long-term appreciation in value versus current income, such as a semi-rural site purchased and held for future appreciation as a community expands. Business property, or IRC Section 1231. This asset is a property held primarily to produce income or for use in a trade or business, such as a retail store, office building, apartment building, or warehouse held as a rental property or user property. A property's classification determines which IRC section is followed and which tax provision applies. Taxable entities and property classifications are significant factors in cash flows of a real estate investment. There are other tax implications to consider as you evaluate real estate investments. By broadening your understanding of tax law and legislation, you can expand your opportunities to recognize tax-savvy investments.